Welcome to our latest video, where we delve into the financial maneuvers of billionaire investor Bill Ackman. Today, we're going to discuss Ackman's initial decision to bet against U.S. Treasuries. This decision was a bold one, based on his insight and understanding of the financial landscape. In the summer of 2023, Ackman decided to hedge against persistent inflation by shorting 30-year U.S. Treasuries. This move was seen as a daring gamble, considering the reputation that Treasuries have as a safe and reliable investment. But Ackman is known in the financial world for his audacious strategies, and he wasn't alone in his thinking. Elon Musk and Warren Buffett, two other prominent figures in the business world, agreed that short-term treasuries were a sound investment. Musk and Ackman both chose to invest their cash in short-term treasuries, while Buffett used them for cash management. Short-term U.S. debt yields had been on the rise that year due to the Federal Reserve's decision to increase interest rates. Ackman's decision was rooted in his belief that inflation and interest rates would remain elevated for years, potentially impacting the outlook for stocks negatively. He anticipated that inflation would be structurally higher in the future and that the Federal Reserve would be unable to maintain a consistent 2% level. Inflation had reached a 40-year high of 9.1% in June and remained at 7.7% in October. In response, the Federal Reserve raised interest rates from near zero to a range of 3.75% to 4%, with the possibility of rates going above 5% for the first time since 2007. Ackman's initial decision to short 30-year U.S. Treasuries was an interesting strategy, but as we'll see, the financial landscape is ever-changing. So why did Ackman bet against U.S. Treasuries in the first place? Let's unpack the contributing factors. To begin with, Ackman's decision was primarily shaped by his predictions concerning inflation and interest rates. He held the belief that inflation would remain structurally higher in the future. Rather than a temporary spike, he foresaw inflation becoming a persistent economic feature. This, in his view, would challenge the Federal Reserve's ability to maintain its target inflation level of 2%. The billionaire investor's predictions were not unfounded. Inflation soared to a 40-year high of 9.1% in June, and still remained significantly high at 7.7% in October. Ackman reasoned that this persistent trend of high inflation would be difficult for the Federal Reserve to contain. Additionally, Ackman held a cautious view of the Federal Reserve's interest rate hikes. He saw these as a double-edged sword. On one hand, they were a necessary measure to curb runaway inflation. On the other hand, these hikes led to an increase in short-term U.S. debt yields. Ackman, along with other prominent investors like Elon Musk and Warren Buffett, identified short-term treasuries as a good investment due to the interest rate rises. Ackman's strategy was also influenced by his perception of the impact of higher interest rates on stocks. He argued that higher rates could devalue companies' future cash flows, thereby affecting stock valuations. This theory is based on the concept of the time value of money, which states that a dollar today is worth more than a dollar in the future due to its potential earning capacity. With such a complex interplay of factors, Ackman's decision seemed sound. But what prompted him to change his strategy? Fast forward to the present, and we find Ackman closing his profitable short bet against U.S. Treasury bonds. But why? Bill Ackman, a billionaire investor known for his sharp instincts and shrewd strategies, recently made a surprising decision. He closed his short bet against 30-year U.S. Treasury bonds, a move that raised eyebrows across the investment world. After all, this bet had proven to be quite profitable for him. So what led to this unexpected turn of events? Global risks and a slowing economy were at the heart of Ackman's decision. The world of finance is ever-changing, often influenced by a complex web of interconnected factors. In Ackman's case, these factors included increasing uncertainties on the global stage and a decelerating economy that signaled potential turbulence ahead. When Ackman initiated his short bet, it was a hedge against persistent inflation. However, the landscape shifted dramatically since then. Interest rates surged, leading to a decline in bond prices. This change in the financial climate meant that Ackman's short bet was now yielding substantial profits. The 10-year U.S. Treasury yield leapt from 4.08% to 5.02%, while the 30-year yield jumped from 4.17% to 5.18%. In the face of these developments, Ackman had a choice to make. He could hold on to his bet, hoping for further increases in interest rates that would drive bond prices even lower. On the other hand, he could opt to close his bet, securing his profits and safeguarding them against potential reversals in the market. In the end, Ackman chose the latter option. he decided to close his bet, taking his profits off the table. This move is a testament to the fluid nature of investment strategies. It's a reminder that successful investors are not those who stubbornly hold on to their positions, but those who can adapt to changing circumstances, even when that means letting go of a profitable venture. Ackman chose to close his bet and take his profits, showcasing the fluid nature of investment strategies. So there you have it, a deep dive into Bill Ackman's recent financial maneuvers. We've explored his initial decision to bet against U.S. Treasuries, motivated by the anticipation of persistent inflation. We've also unpacked the reasons behind this decision, including the potential for higher long-term interest rates to impact stock valuations negatively. Finally, we've looked at Ackman's recent move to stop betting against U.S. Treasuries, a decision driven by the increasing global risks and a slowing economy. Remember, investment strategies are never set in stone and always respond to the global financial landscape. If you found this video insightful, don't forget to hit that subscribe button and join us for more financial deep dives. Until next time.